All right, we're going to go ahead and get started. Welcome, everybody. My name is Tom Schmidt. I'm one of the co-founders of Ticker Tape Investments, and this is another installment of our TTI educational series. We're going to talk today about how to invest like the super wealthy, and we'll get into that in just a minute. A couple of preliminary matters. First of all, there is the little Q&A function in the GoToWebinar app, if you will, and ask that you guys pop in comments and questions. We are going to have a Q&A session at the end where we'll go over those and also get some audience participation here. The QR code that's on your screen gets you connected to Ticker Tape Investments just as easy. You can go to ttifund.com, click on Contact Us, and on that contact page, there's a list of our social media accounts where we're posting educational content over time that you guys can take advantage of. In the Q&A of this presentation live and also in the comments of wherever you see this online, I'd love to hear feedback from the audience as to what other types of presentations would you like to see us do? Stuff about due diligence or different types of investments or maybe crypto. But we want to obviously serve the audience and make sure that we're providing content that's relevant to you guys, whether it be live presentations like this one or articles that are posted on our sites. For example, we did one recently. We have a deal that's on the screen there. USA Rare Earth is about to go public, and they're doing one of those SPAC deals. Well, one of our investors in the deal sent me a note and said, hey, I heard you say it's going public through a SPAC. What does that mean exactly? So we created a little article about what is a SPAC merger, how does that work, and posted that in the context of the USA Rare Earth deal investment that we had made. So we want to make sure we help you guys learn about all these different things that we're doing, these different moving parts. Before we get into the content, what is Ticker Tape? For those of you who don't know us, we are just a group of loosely affiliated investors that pool our capital, our expertise, and our deal flow to find, evaluate, and make investments in all sorts of different asset classes. The name of the game here is diversification, and by that, you've heard me say before, I do not mean a large cap growth fund and a small cap value fund. I mean outside of the stock market. If you're in lots of different things in the stock markets, including international stock markets, you are not diversified. And so we work very hard to get the Ticker Tape investors invested in as many different types of deals, not just many different deals, but as many different types of deals as we can. Currently, we have 4.5 deals open. TTI Utility Rescue, you've probably heard about, is our current pre-IPO deal. We have a debt fund that just has no equity upside, just a consistent cash flow payment for those of you looking to get income from your cash. We do have a multifamily deal that is open, a metaverse deal, and then we're working on a new one. It's kind of quasi-open, is TTI Mexico 1, which is our first real estate deal in Playa del Carmen, Mexico. Excited about that one. We actually had a call today. We're moving forward with a vacation rental deal that is 18 freestanding, what do you call them, single family homes in the St. Louis market that are being acquired to be operated as short-term rentals because the sort of experience we've had as investors and talking to others is that if you have a real estate investment, you can get a higher return from a short-term rental if you manage it properly. And so we're looking to do another one of those investments as well. So that would be, I guess, the 6th one right here very quickly. We've had multiple exits, including multiple pre-IPO deals, Palantir, SoFi, Outbrain. We have USA Rare Earth coming up. We had some debt promissory notes mature in the TTI debt fund. And of course, we had the Surgery Centers deal, which liquidated as well. Who is Ticker Tape? Well, technically, it's not really a business. It's not really an ongoing entity. The two founders are Rita Carpel and myself. Rita's on the call with us also. And we basically just kind of manage a group of investors who invest together in various deals. We put our own capital, that is Tom and Rita's capital, into each deal that we do. So if you hear us talking about an opportunity, that means we put our own dollar bills in the deal. Different amounts, some of them for me end up in the hundreds of thousands of dollars. I think the smallest one I did, which now, of course, I'm regretting not putting more in, was Ripple. I think I put $5,000 in that one because I saw that as a much higher risk proposition, and so I wanted to limit my risk exposure. And that's the cool thing about ticker tape is you're not investing in us where we then make decisions where to put your capital. We put a deal together. You can opt in or opt out. If you don't want in that one, no worries, no problem. You may not like the St. Louis vacation rentals market, but you really like SpaceX, so you invest in our SpaceX deal and not our vacation rental deal. Let's get into the meat of today's presentation, how to invest like the ultra wealthy. I want to back up one quick second, kind of talk about why I'm doing this topic, where this comes from sort of in the ticker tape universe. And when we started ticker tape, one of the very first principles that the founding group talked about was, let's not do this on our own. Let's copy and follow much more successful investors. So we started looking at, hey, you want to invest in an early stage company? Who else is invested in this company? We had one deal we did where we were co-investing with the former CEO of Walmart. Said, hey, you know what? That guy knows his stuff. We did a restaurant deal with the former, I think he was the CEO of Olive Garden, not Darden, the parent, but the former CEO of Olive Garden restaurants. Hey, you know what? He knows his stuff. Looking at highly successful venture capital funds and, hey, this company Kraken, I'm not very familiar with them. I can find them online, but how do I really know it's going to, well, let's look at who the early stage investors were in that deal. Palantir. Well, Peter Thiel was the first big investor in Facebook Meta. He was also one of the early investors in Palantir. That gave us some credibility for that business, which, by the way, when we first looked at it as a potential, I had never heard of it. A lot of people have heard of it now. It's hitting all-time highs on the stock market. But who else is invested in the deal is a good indicator. Doesn't necessarily mean the deal is going to be successful, but it's a good indicator of deals that ticker tape will move forward and look at. So similar things here, right? Well, it turns out through some research that we did recently, it turns out that if you categorize people as ultra wealthy or billionaires or some sort of higher level of income and investing expertise, it turns out they invest very differently than the category we normally call high net worth individuals. Also very differently from the category of retail investors or everyday investors. And so we said, hey, you know what, let's look at this and let's see what we can learn from it that becomes helpful in changing how we invest in 2025 and beyond. And does it reassure us of some of the goals we have, some of the philosophies we have, or do we need to start questioning what we're doing, maybe broaden our horizons a little bit? And when I looked at this data, I said, man, this is awesome. This is very helpful for me. And so I want to share it with the ticker tape audience. But the price of admission is I need you to put a question in the question box or a comment in the comment on YouTube or Facebook or wherever you're seeing this. Tell us, what is your #1 investment goal for 2025? This is helpful to us to get feedback, and we'll talk about your answers at the end of the presentation. So go ahead and pop into the Q&A. I think it's a questions function of GoToWebinar if you're on with us right now, and type in what is your #1 investment goal for 2025. Without further ado, why do ultra wealthy investors invest differently? And that is a very important question for us to understand if we're going to look at how they invest and consider following their strategies for ourselves, right? Because there may be reasons that they're behaving a certain way that don't apply to us. And therefore, you've got to take that into your analysis of, should I invest the same way they do? And it turns out that they are going to focus on long-term results. They're going to focus on wealth preservation, which is maybe something we're not doing and shouldn't be worried about at this point, depending upon where we are as individual investors in the wealth building game. They also focus on tax efficiency, and they also look for high yield investments. I've done a lot of research on this. I've read a lot. I've heard a lot. I've talked to a lot of people about it. One of the main things I've heard, which seems to have been relatively common in the world of what do billionaires do, how do they think, once you get to a certain level of income where not only is your wealth covered, but so is that of your children and your grandchildren. Now you're talking about generational wealth building. The general consensus is that the only real threat to you, aside from obviously wasting money, which at some point it's hard to even waste enough money to damage a multi-billionaire asset base, the biggest thing is inflation. Because when, and it's funny because I think about this all the time. I think about, what am I going to leave to my grandchildren? Before I had kids, it's funny, I always thought about building for my children. Now I have children, chances are I'm not going to have any more children. And so, okay, now for some reason I'm focused on my grandchildren. And what happens is, I think in terms of, hey, I want my grandchildren to have certain things. Obviously, we have a ranch that is very important to our family that I want to make sure is preserved for the benefit of my legacy, I should say my father's legacy, because he actually bought it, grandkids, great grandkids, etc. My children will inherit an interest in a house in the south of France. I think that's a very cool thing. I want to give that. But then we want to talk about the wealth and what I'm building, why, I've kind of covered my own situation for the rest of my life. Now I'm looking to improve upon that for the next generations. And the thing I never think about is the time, right? You think in terms of, hey, I'm going to have this many dollars that will then generate a return, and then hopefully there'll be that money for those grandchildren or great grandchildren or whatever. And the part I never really thought about was, you're talking about 30, 40, 80 years. And when you talk about the impact of inflation over the next 5 years, it's one thing. When you talk about the impact of inflation over 80 years, it's a whole different equation. So I know lots of you guys aren't at that stage yet. I'm technically not at that stage yet. Technically, I don't have cash or liquid assets sitting somewhere that are going to provide for my great grandkids. But I've got a program going that is building towards that. And so I'm keeping my eye on that ball. But if you have billions of dollars, all of a sudden inflation becomes a much bigger issue, because you're really thinking in terms of multiple generations later. And so as a result, you're talking about 20 years plus per generation. That's a lot of years for inflation to eat into your assets. And so that's a key factor that is on the radar screens, maybe front and center of the radar screens of a lot of billionaires and ultra wealthy people, that maybe doesn't need to have the same impact on you. The second thing they're going to do is wealth preservation and asset protection, because the last thing they want to do is have a $30 million lawsuit come erode a significant portion of their assets. So they're going to do things like put assets in trusts. They're going to make sure that their children and their grandchildren have education and restrictions on how they spend the money. You may have heard me talk about legacy and how important that is, and how the Vanderbilt family created trusts for the next generation, but didn't put restrictions on how they could spend the money. You want a Ferrari, the trust buys you a Ferrari, go have fun. In the Rothschild family, by way of contrast, the kid had the same trust. The kid could still go buy a Ferrari. The difference was the kid had to borrow the money from his trust to buy the Ferrari and, wait for it, pay it back. So what that did is when that kid, if that kid bought a Ferrari, it did not decrease the value of his trust because he had to go earn money from some other source to pay a loan back to the trust to maintain the value of that trust. Of course, you can imagine after a couple generations, the impact of those two processes on the total amount of wealth that remains. So those kinds of things are very important to billionaires. Now, on this slide, the couple bullet points I want to focus on are long-term results. So if you want to think about the future down the road, you got to think a little more long-term. The other thing is high yield, right? You want investments that are going to give you more bang for your buck. And I'm not only talking about debt. I'm not talking about high yield debt because high yield debt tends to have a higher risk profile. They want to generate a higher return, a higher yield from their portfolio. And so they're typically, the punchline of all this is going to be, they're going to focus more on private equity, venture capital, and alternative investments because those are the things that are going to drive more bang for your buck. One more little vignette I want to throw out there because it's one of my all-time favorite things, because I'm sitting there listening to one of my favorite comedians, Chris Rock. I know he's controversial. A lot of people like him. A lot of people don't. I just think the guy's funny. But one of the first little vignettes I heard from Chris Rock years ago was somebody asked me, what is the difference between someone who's rich and someone who's wealthy? And his explanation was, he goes, Shaquille O'Neal, that guy's making, $30-40 million. He's rich. The white guy who writes his paycheck, that guy is wealthy. And so that's a funny little vignette about the difference. So we're really not talking about high net worth or high income people. When you hear high net worth individuals, that's not who I'm talking about when I say ultra wealthy. I'm talking about billionaires and people with family legacy money in at least the hundreds of millions, if not in the billions. And it turns out that when we did research and we looked at where are billionaires and the super wealthy putting their money, the answer is they have a very different portfolio allocation than high net worth individuals do, or even that I do. And so I wanted to share this information with you guys. It turns out that billionaires and ultra wealthy have somewhere in the 20 to 40% range of their total portfolio in private equity, pre-public companies, venture capital, private equity investments, et cetera. And that's not counting alternative investments or real estate. So when you add up those three areas, you're talking about a majority of their portfolios are not in public markets or bonds or cash, right? You've got, in this case, you can see 71% in the little pie chart is combined private equity, real estate and real estate debt, and alternative assets. And by alternative assets here, we're talking about anything that's not an equity investment or a real estate investment, right? So you're talking about cryptocurrency, you're talking about paintings, you're talking about expensive wine, expensive coins, collectibles, things that truly are alternative assets, which, by the way, are harder to get access to if you are a person like Tom Schmidt, or even a high net worth individual, high income Americans. Those are hard things to get access to. But when you get to be at the billionaire level, all of a sudden they become a lot more accessible. And so I found this pie chart very educational in terms of where these people are putting their money. And so you got to start asking yourself, first of all, why do they have 8% of their assets in cash and bonds? My mother was told, you're retired, you should have more than 50% of your total portfolio in cash and bonds. Well, first of all, that's good advice if you need your nest egg, your total portfolio, if you need to live on that money for your lifetime. You don't have other income coming in to cover your expenses. You're living comfortably off of some other income stream. in that case, you do need to make sure to preserve your wealth, your assets, by having lower risk investments, money markets, bonds, etc. Once you're a billionaire, that need goes away. So the question is, if you look at this and you go, all right, when I get to the ultra wealthy stage, I want to be somewhere in that 8% range for cash and bonds, right? So right now, Tom Schmidt, I'm not retired. I have a very small percentage of my total assets in bonds or cash because I'm still in that wealth building stage, right? My mother, before she passed, we had her at about that 50-50 level where she had about 50% of her money in stocks, bonds, and private equity, and about 50% in bonds and cash. Now, she was in an unusual position in that she was never dipping into her portfolio for living expenses. She was sort of on that cusp where she was able to live off of her income coming in from other sources and the appreciation or the interest from the bonds in her portfolio. And so in that situation, she had a good allocation. The point here is everybody has a different situation. If you're still earning a high income and you're growing and building wealth, lower amount of cash and bonds. If you are retired and you don't have enough money in your portfolio to take risk to grow and increase the size of your portfolio, have more cash and bonds, right? If you need those bonds, the interest on those bonds to live on, that makes sense, have a higher percentage there. But once you get past that to the point where you can start taking more risk, or if you're younger and you're in that wealth building stage, then it's acceptable to have a lower percentage in cash and bonds. Last thing I'm going to say about the pink triangle is think like not just billionaires, but billionaire investors. So you have, the Oracle of Omaha, right? One of the most successful investors of all time. When COVID hit, he had huge amounts of cash on hand so that he could take advantage of buying companies that were struggling at the time that he could buy at a lower price. So that's a part of why ultra wealthy people keep cash in bonds, is because if, for instance, the stock market were to crash, they would watch that, let it happen. Once it settles, take some of that those cash and bonds, move them into public markets. If they see private equity opportunities that are unusually attractive at a particular time, they have that cash and bonds liquidity to be able to take advantage of opportunities. Maybe a painting that they like comes on the market, they have cash to cover it. I've also, the other thing I want to comment on is you guys have, those of you that have been with Ticker Tape for a while have heard me say that there's this great myth in America, a function of simplicity and convenience, that Americans are told you should be invested in the public markets. And I'm guessing that the majority of you on this call have a larger than 22% portion of your portfolio in public markets. I am probably around 30% of my total investments, let's say equity investments, not counting bonds. 30% of my portfolio is probably in the public markets. Now that I've read this material and read these studies on what super wealthy people are doing, I'm going to start shifting more of my assets into alternative assets and into real estate and into private equity. And there's a bunch of reasons why that's their focus. We'll get into those in a minute. I thought this chart was also awesome. I wish I had one that had 3 bars for each category. This is one I copied from an article out there that compares what they call ultra high net worth people with high net worth people. So these are the $10 million net worth. These are the billionaires. And you can see that they've grouped private equity under alternatives, and they're showing that ultra high net worth people put close to 50% of their assets in private equity and alternatives. So if we look back at my chart, I've got that at a higher percentage if you include real estate. And so my data is a little more specific, breaking those three categories out. But the exact percentage isn't relevant. What's relevant is look at the difference between ultra high net worth with private market investments versus stocks. And you can see that there's this shift, right? The high net worth people have a higher percentage in stocks and a lower percentage in private investments. And then the ultra high net worth focuses more outside the stock market. Let's talk about why. Again, some of you that have been with Ticker Tape for a while have A, seen this chart, and B, heard me have this conversation. I've known forever that private equity investments outperform the stock markets. Why is that? There's a bunch of reasons. There's a bunch of reasons why private equity is better. The reasons why billionaires invest in it is basically that it builds generational wealth, that the risk return profile is better. And it's not just the risk return profile, it's the long-term growth in the asset versus market volatility. Y'all may have seen we posted a couple articles online about this DeepSeek AI large language model disrupting the stock market. I assume y'all saw that a week ago or so. A report came out that DeepSeek built something that competes with ChatGPT, and frankly, I've used it. I think it's better than ChatGPT for $6 million. And that disrupted the tech stocks in the stock market because all of a sudden people are like, oh my gosh, our expectations of what businesses are going to spend to build out and use AI systems are way too high. Therefore, companies like Amazon, Google, Oracle, Microsoft, and yes, you guessed it, NVIDIA are not going to make as much money as we thought because the everyday companies, the non-tech companies won't have to spend as much to take advantage of AI. So NVIDIA in one day lost $600 billion of market cap. That's never happened before, by the way. That's the largest drop in market cap for a single company in history. And it was all because of this DeepSeek thing. Well, if you were invested on that day in a privately held company focused on AI hardware, guess how much your investment declined that day? Zero, right? Privately held companies aren't subject to that same volatility. And so long-term investors, billionaires, like that long-term stability versus having that greater market volatility. The other thing is you get the biggest gains, right? One of the sayings I hear time and time again, and you'll hear me repeat, is that by the time the company goes public, the money's already been made. And so this is happening more and more in our society when private equity is available to these companies to help them grow. They don't have to go to the public markets in order to get capital, so they get to take advantage of private equity investments. And so they're growing and coming of age, if you will, before they go public. So when they go public, it's at a multi-billion-dollar valuation. What does that mean? When you hear, hey, Kraken's going public at a multi-billion-dollar valuation in a few months, what that means is that the early private investors like Ticker Tape made those billions of dollars out of zero, right? Because that company started being worth zero. The founders got a big chunk of the value. The early investors got a big chunk of the value. And then at the end, groups like Ticker Tape, that's a late-stage pre-IPO investor, we capture that last bit of value before the company goes public. I'm not saying you can't make money on Meta or Airbnb after it goes public, but the money that's made by these companies before they go public dwarfs the amount that's made once they go public. Companies like Dell, Amazon, Meta, Tesla, Airbnb, and Uber all made billionaires before they even went public. Another topic that billionaires focus on is alternative assets whether that's private real estate, private credit and debt financing. Farmland is a big one. Guys like Bill Gates, you've probably seen, have invested enormous amounts of money in farmland. The idea again is when you change your time horizon, it changes the things you should invest in, because the longer time horizon you're looking at, the less clear it is what's going to happen, right? I could make an argument that the hot AI investments of today, companies like NVIDIA, will be worthless in 100 years because we'll be moving to some sort of electrons in the atmosphere being used to do our computing, and no one has to manufacture a chip. So companies like NVIDIA, we go right past them, kind of like Kodak, right? Kodak was the bomb when everybody had to buy a camera and go pay to have their film developed and buy another roll of film. Company's basically gone now. Same thing could happen there, but you know what's likely to always be valuable? Farmland, right? Because no matter what the technology is in the future, somehow we got to grow food. Now, I could argue they're going to make it in a factory and maybe that reduces the value, but by then they'll want to build on that land. So the land is a finite resource that has that sort of backup thing. Crypto, blockchain, art, wine, collectibles. You see on this page that word correlation. And even for non-ultra wealthy investors like Tom Schmidt, it's important that I have a significant portion of my assets invested in things that are not correlated to, number one, the stock market, because a ton of stuff you're investing in is correlated with the stock market. And so if the stock market goes down, your other stuff goes down too. Number two, not correlated to the economy, right? We do lots of real estate investing. We do some, I don't want to say low income housing deals, but we do some sort of mid income housing deals. I want to have more real estate type investments that are likely to do better if the economy declines. So we're looking at mobile home parks. We're looking at self-storage facilities, real estate related assets that if the economy declines, they will at least stay the same. We kind of feel like our apartment investments do pretty well. Of course, that, we saw some apartment deals fail during COVID because people stopped paying their rents. Fortunately, we avoided that, but I know a lot of people had problems. We want stuff that's not correlated to the economy and not correlated to the stock market. And here's a great example of this, right? So I put a bunch of my money in cryptocurrencies, mostly the big ones, Bitcoin, Ethereum, Ripple, Solana, a couple others. My thought was that I was diversifying away from correlation to the stock market. And theoretically, it is not correlated, and probably over the long term, it will not remain correlated. But over the last 5 years, go lay a chart of Bitcoin over a chart of the Dow or the S&P 500, and you see they're correlated. When the stock market declines, Bitcoin goes down. When the stock market goes up, particularly for what we call speculative reasons, hey, tech's growing, AI, there's AI news, that sort of thing, you'll see Bitcoin go up. And so I've been frustrated that I didn't get that counter correlation that I thought I would when I was buying crypto. But over the long term, the lesson is alternative assets can help improve diversification. They can perform better. Things like art and collectibles have outperformed stock markets and even private equity investments over time. Real estate deals are great, right? Because you have that land as the backup, that wealth preservation component benefit from the land. And so that is kind of a backup for your investments in that regard. And so the idea is that you are getting upside, right? The thing's growing, it's generating positive cash flow, but it is backed by a hard asset. So that's a great component of the billionaires and the ultra wealthy's portfolio strategies. All right, let's talk a little bit about wealth protection and estate planning, because this is obviously critical as well. And I love this lesson because there are components of these strategies that billionaires and ultra wealthy investors take advantage of that don't apply to me. I'm not there yet. I don't need to do the kinds of things that they do in these categories, but there are components of it that I can learn from them and apply to myself today, but then also be aware of going forward on an ongoing basis. So for example, I do not need today any offshore asset protection. In the future, though, that's something I want to be very cognizant of. Number one, my family, my extended family, I should say, we travel a fair amount outside the country. I would like to live for extended periods of time in other countries when I'm able to start moving towards retirement. One of my dreams is to go live in London for, say, 6 months or so, maybe even a year. I'd like to spend extended periods of time in resort areas of Mexico. I enjoy fishing and the sea life sort of experiences, as well as beaches and other components of whether it's Cabo or the Riviera Maya. And so I'd like to spend more time down there. And both my children are fluent in French. They both expressed interest in living in France sort of long term. So of course I want to be able to go there. So all of a sudden not today, but my focus is, you know what, I need to have some offshore investments, which will serve the dual benefit of being outside the United States and give me access to them if something were to go wrong and I'm outside the United States, but also asset protection. You may know I'm a lawyer, and so theoretically I could be sued by a client and have to worry about asset protection things. And of course, I have asset protection components in effect right now, but they're all onshore, right? They're all US-based trusts or limited liability companies that don't give me that sort of offshore protection. Again, if your income if your taxable income is in the tens of millions of dollars, then doing things like moving to Puerto Rico more than half of the year to avoid paying income tax becomes a $3, $4, $5 million a year benefit, and all of a sudden it starts making sense. I'm able to, using trusts and foundations, I'm able to, and also tax favorable investments, I'm able to eliminate my tax liability given my current assets and my current income. So these are things I'm looking at long term, but for now I'm good. But certainly 1031 exchanges are a great way to manage a real estate portfolio, sell an asset without paying tax on it by moving the money into a new real estate investment. I've never actually invested in an opportunity zone, but I've done business deals with parties in opportunity zones and taken advantage of the tax benefits. The one I'm most familiar with is in the Elizabeth, New Jersey area, suburb of New York City. You may know gosh, I've forgotten the name of it now. There's a big outlet mall over there in New Jersey that was built in an economic opportunity zone. And so the people who shop there pay significantly less sales tax than regular stores in New Jersey, let alone stores in New York City. I've seen people open hotels in opportunity zones and take advantage of reduced taxes, which of course goes straight back to the investor's return. And so great way for folks like us who are not yet ultra wealthy investors, billionaires, et cetera, to take advantage of the same strategies, get an immediate benefit to help us grow our own wealth and take advantage of those things. All right, Q&A time. Any questions from any of that? If you have a question, pop it into the Q&A section. And I see a couple of you have not put in your investor goals for 2025 yet. Please pop that into the questions function as well. And I'll give you all a couple seconds to ask any questions, and then we'll answer. All right. I'm getting lots of grow my portfolio and also earn income for the 2025 goals. I was sort of hoping for more detailed answers, but that's acceptable. As far as Q&A go from the presentation, so one question that's already come in that I guess, at Ticker Tape, we've gotten this many, many times, is how can an individual investor access private equity and pre-IPO deals? The answer is, it's one of those things in life that is very easy, but it's sort of difficult to figure out how, right? Once you figure out how, it becomes a lot easier. At Ticker Tape, we end up doing a lot of that work for you. So we are looking for these deals for ourselves, and so we put them together, we vet them, we negotiate the purchase of, let's just say, pre-IPO shares. We tell you the price, we tell you why we think it's a good price and why we're putting our cash in it, and then you have the opportunity to invest with us. I've seen, it's funny how life works, right? So a couple of deals we did, we would put a deal together. Here's the price, let's just say $20 a share. I've seen investors come to me 6 months later and say, dang it, Tom, when you did that deal, I thought $20 was too expensive, and so I didn't invest, and now I just bought shares for $24 a share. But I've also seen guys who said, hey, Tom, I know you did, I think this one was Indigo Agriculture, and your last one was $28 a share. I was able to get shares at $24. And so, it's one of those things, right? Depending upon when you invest, the share price might be different. Also, we believe, and we've seen this in practice, that because Ticker Tape is investing a larger amount of cash in each deal than Tom Schmidt would, that overall, over time, we're getting much better pricing, right? In other words, I can negotiate a discount or a higher preferred return on a hotel deal or a different profit split with the founders because we're investing a larger amount of money. So almost always, the fact that we're investing a larger amount means we get better terms. However, if you're buying, let's just say, shares of Kraken from an individual, we may be buying $1 million worth of Kraken at $10 a share, but there's some investor who's willing to sell $25,000 worth of Kraken at $9 a share, right? So yes, the investor was able to get his shares cheaper. You can't buy this many shares for that price, right? So that does happen in the market. But the short answer to the question, how does an individual get access, is number one, easiest way is through Ticker Tape. Invest with us going through the same process we're doing. Number two is meet other investor groups that do this kind of investing, follow them and invest with them or alongside them. Number three, for private equity deals, if you don't want to evaluate deals on a deal by deal basis, you can just invest in a private equity fund, right? One of the ones I like for smaller investors is called Our Crowd. They give you an unusual amount of flexibility in, do you want to invest in their self-driving cars fund, where you put 100 grand in and then they allocate it against, among the companies they want to invest in? Or would you rather invest in 3 of the 10 self-driving car companies that their fund invests in? They let you actually tag along and invest with a single company so that you have more control, sort of how you pick and choose, or I should say, how your cash is invested. Because at Ticker Tape, we started with a venture capital fund. We said, hey, everybody put their money in. We'll vote on whether each deal we invest in, but if you're in Ticker Tape, you're in the fund, you're going to have ownership of every deal we do. And we very quickly learned, because that's how everybody else does it, right? If you find a venture capital fund to invest in, that's how they're going to do it. You're going to put your money in the fund, They're going to decide what to invest in and how much, and you're going to be in every deal they invest in. We figured out pretty quickly that's not what investors want. Individual investors, they want to decide which ones they're in, which ones they're not. So we very quickly changed to this strategy of what we call single purpose vehicles, where we put a Kraken partnership together and we invest in Kraken, and you can either invest in Kraken or not. And you say, you know what, I don't want to be in a cryptocurrency trading exchange. I'd rather skip it and put my money in the next apartment deal you do. And so some people do that. Some of our investors invest in every single deal we put together. Some of them only invest in one or two. And some invest the same amount of money in every deal. Some put 10 grand in one deal and 100 grand in another deal. SpaceX is a great example of that. We saw investors that had invested with us in multiple opportunities all of a sudden put a larger amount in SpaceX, I guess because people were willing to have that longer term perspective, weren't looking for a quicker return, but they obviously had a high level of belief in that business. I have another question that just popped in from Crystal. How is the TTI fee structure set up for pre-IPO deals? So great question, very common question. The answer is the fee structure is different for every deal by deal. It's affected by questions like who is involved in putting the deal together. Sometimes we have other parties that either brought us the deal or somehow participated in vetting it, and so they take a piece of the fees, so then the fees tend to be higher. I'll tell you that if there are deals where we expect regular cash flow, like a multifamily deal, then we have to charge a slightly higher fee because there's more work for us to do tabulating the cash and paying it out on whatever that schedule is that the money comes in. Any opportunity where we are making management decisions, the one example of this right now is the TTI Metaverse Fund, where we're investing in early stage crypto and metaverse real estate, and we're buying and selling assets like a fund. There's more active involvement in the process, so we charge a higher fee. The way to think about it, to kind of give you a more direct answer to your question, the highest fee we charge would be 2% and 20%, which is the standard private equity fund fee structure. That's what venture capital firms and private equity funds, some charge more, but the vast majority charge 2% of the invested assets per year, plus 20% of the upside. But we almost never charge it that way. It's always some discount to that. Maybe it's 1% and 15%. Maybe it's maybe we do take 20% of the upside, but it's after you get all your money back, plus all your fees back, plus an 8% annual preferred return. So in other words, it's adjusted in that way to make sure that the investors are actually getting a return before we get any upside on the back end. So the answer is look at them deal by deal. If for some reason it's not immediately obvious, we always have a slide in every presentation that says, here's the fee structure, should be obvious. If it's not, just ping Rita and say, hey, what's the fee structure on this one? We'll be happy to share it. Having said all that, the current pre-IPO deal, which is utility rescue, which you may have seen our presentations for, there are 0 fees charged for that. I am the co-founder, CEO, and member of the board of directors of that business, one of the founders that kind of put the thing together, and therefore there's somewhat of a conflict of interest there. So Ticker Tape does not charge a fee for utility rescue. You would be investing directly into Utility Rescue Holdings, Inc., and there's no management fees or success fees. You keep all of the upside from that particular investment. We have done that before. I think one other time, it would be rare, right? And it would be some sort of situation like that where someone affiliated with Ticker Tape has invested directly in the business as opposed to with you, and therefore has a vested interest in the business being successful. So in those situations, we don't charge any fee at all. Crystal, I hope that answered your question. We have the question, how does private equity compare to public stock market returns over time? There are a number of ticker tape articles that we've posted that discuss there are very specific differences in the return. I haven't memorized that information. The short story is that private equity deals have outperformed the S&P 500 over just about any time horizon of more than a few years. There are occasions typically where you can see on this graph, you can see the, the Great Recession decline in the stock market, and some private equity companies actually declined there because of real estate, frankly, right? Because there were defaults in real estate where your asset literally went to zero. And so in that scenario, you had a decline in private equity. What tends to happen if that happens is that the stock market, as you can see on that graph, tends to recover faster, and it takes private equity longer to catch up. And so there are sort of short periods of time where private equity may underperform, but over the long term, you can see where private equity has dramatically outperformed the S&P 500. And so that's kind of how we look at that. Running out of time, but Crystal had another question. Are all the companies under utility holdings part of that pre-IPO investment or just utility rescue? So great question. So Utility Rescue Holdings, Inc. is the entity that you would be investing in. That is a holding company that doesn't have any other parents. All of its business is held in 5 subsidiaries. And so that parent company is what would go public. So and by the way, if you've seen my top 5 mistakes presentation or 6 keys to private equity investing, one of the lessons I learned as a litigator representing investors is don't ever invest in a deal where your class of investment is different from the people who are asking you to invest, right? It's a trick that fraudsters use where, oh, well, your stock has this different treatment, and so it's treated differently. Here, you're buying common shares of Utility Rescue Holdings, Inc. Those are the shares that will be listed on a publicly traded exchange. It's not some subsidiary or a part of it. The whole business is going public. One last question I'll answer because I think this is a good one, although I don't really have the time to go into it in detail. Maybe it could be the subject of a different presentation, but there's actually 2 different questions that are similar. One is, what types of real estate investments do ultra high net worth investors prefer? And the second one is, how do wealthy investors structure real estate deals for tax efficiency? So those are great questions. Not a lot of time to do that today, but I can tell you that people who have significant income looking to shelter that income from taxes will invest in deals that have a lot of depreciation associated with them, typically not raw land, typically not farmland, although if you invest in a farm that owns land, you can get depreciation from the equipment, that sort of thing. They're looking for buildings and other, fixtures that are installed on the land that you can get benefit from accelerated depreciation from. So that's the preference is going to skew in that direction, and that's going to be a big part of how they do it in a tax efficient manner. Of course, the big thing is 1031 exchanges. I don't know why I always say 1013. It sounds like a CB radio code or something. 1031 exchanges, where you eliminate tax liability on your real estate sale by rolling it into another asset. And so that's a very common strategy or answer to the question, how do they structure them? Then beyond that, it gets into, you create an LLC, you pair that up with active income so that any passive losses can offset the active income and end up not hitting the tax return. Also, they're going to be looking for what I call real estate deals with an upside. In other words, they're going to be looking for properties and investments that they can make where let's just say it's not fully occupied, that operational changes can be made to improve the operations of it to generate a higher income so they get a better benefit, more bang for their bucks. We're going to go because it's been almost an hour and I don't want to keep you all any longer. I do have a couple more questions here that I'll put into our blog and answer those online. Obviously, you're welcome to reach out to Rita and get answers to any other specific questions that you have. In conclusion, key takeaways from this are: invest like the ultra wealthy, focus on private markets and alternative investments rather than the stock market. Number two, protect your wealth, use tax efficient strategies and estate planning tools to, it's one thing to make a lot of money, it's another thing to keep more of that money. And then third, position yourself for 2025, get access to exclusive investment opportunities, follow the big boys, follow the venture capital funds that have had track records of success, follow the high profile investors, Warren Buffett's of the world, Bill Gates's, Mark Cuban's of the world. What are they investing in? And follow those kinds of things and find ways to partner with groups like Ticker Tape that can get you access to deals like that, exclusive deals that not everybody has access to on the same terms that you can get as part of a group, a fund, etc. Last, if you have any questions, you can reply back to however you got the invite to this event, or you can reach out to Rita Carpel. She handles investor relations for Ticker Tape and Utility Rescue for that matter. Her phone number is 832-459-7335, or you can email her at rita@ttifund.com. Thanks, everybody. It was great. Thank y'all for coming. We'll see you on the next one. Have a good one.